I'm Anastasia Moroso, and this is Beyond 60/40. Today, I'm joined by Joan Solotar, Global Head of Private Wealth Solutions at Blackstone, and she discusses regional differences in the speed of adoption of alternative investments. Then, iCapital Managing Director of Structured Investments, Steve Zick, helps us answer your question of the month. And as always, I share the one thing that caught my attention this week in private markets. Let's get to it. In today's private market poll snapshot, the one thing I'm focused on is what our third quarter 2024 iCapital Flow Funds data is telling us about investor activity within alternatives and specifically in the private wealth channel. One notable development in particular jumps out from our latest quarterly report, and that is increased investor interest in private equity fundraising. Indeed, in the third quarter, demand for private equity bounced back, accounting for 46% of total inflows, up from 33% in Q2 and 35% in Q1. And within this category, growth equity and venture accounted for 25% of total private equity inflows, a level above recent quarters and 2023, though still somewhat softer than 2022. Meanwhile, demand for private credit products remained in line with year-to-date allocations, representing about 37% of overall flows. And real assets allocations continue to slow to 12% in the third quarter, down from 17% in 2023. But I will note, however, that this is primarily driven by cooling demand for real estate products. But on the flip side, infrastructure allocations continue to rise and now represent 32% of all real asset allocations this year. So let's dive a little deeper into what's driving this renewed sense of optimism about private equity. First of all, continued economic resilience, improving business confidence, ongoing rate relief, and a general recovery in private and public market valuations have all helped improve the sentiment around private equity. Second, this economic backdrop is translating into constructive developments within the private equity investment space, where both deal activity and exit activity is picking up. In fact, overall deal activity within private markets is on pace to top $2 trillion this year, which would be an 18% increase from 2023 and would take us back to levels on par with what we've seen in 2019 and 2020. As a result, dry powder has actually decreased from $4.3 trillion at the end of last year to just below $4 trillion this year. We think this uptick in activity is also partly driven by cheaper financing that is now available. Indeed, there has been a notable pickup in broadly syndicated debt issuance this year, exceeding $980 billion of debt and making it a record year, with most of the issuance, though, focused on refinancings and reprices. For private equity managers, this cheaper debt improves deal economics, creating a friendlier environment for getting deals done. Lower rates also mean that coupons on floating rate loans that are often tied to private equity transactions are resetting to more favorable levels. And that should help company financials by improving net interest coverage ratios and free cash flow, which also gives the managers more confidence. Also, after 2 years of stagnation, the long-awaited pickup in exits is finally here. Through the first 3 quarters of 2024, aggregate exit activity has already matched full year 2023 levels and is on track to hit the 10-year average. We're seeing also an increase in both IPO as well as sponsor-backed M&A activity, both of which should help monetization and therefore shareholder returns. And this brings us to the third and final reason for increased interest in private equity, which is greater outperformance expectations. As public stocks have rallied, their forward return expectations have declined. While private equity valuations have also increased, they're still below those of public markets. And as a result, the expected outperformance of private equity has widened to about 340 basis points on average expected over the next 10 years. Bottom line, we see several reasons to feel more optimistic about the private equity opportunity. And as we see from the latest iCapital quarterly platform flows, investors seem to agree, as we see more optimism translating into greater allocations. And that's your one thing in private markets this week. I'm pleased to welcome my first guest today, Joan Solotar, Global Head of Private Wealth Solutions at Blackstone. For the past decade, Joan has been focused on providing high net worth clients and their advisors access to institutional quality products across a diverse range of alternative asset classes. Joan sits and serves on both the firm's management and operating committee. Thanks so much for being here, Joan.
Thank you for having me.
It's great to see you today. And you've been at Blackstone for some time, but prior to coming to Blackstone, you were actually in equity research. And I guess I'm curious a little bit to hear about your career journey and what made you make that switch from equity research. And by the way, you were covering financials to go work for one of the financials companies.
So I had spent a career in equity research. I covered the brokerage industry and asset managers. I had worked on quite a lot of IPOs, including Goldman Sachs and DLJ, the firm I worked for.
Yeah.
And when Blackstone filed to go public, I joined to help take the firm public, build out shareholder relations, public affairs, and I ran strategy.
Right. So you've seen the future growth opportunity. So what was the origin of starting a focus on private wealth clients within Blackstone?
So the origin really was around how do we expand distribution beyond U.S. pension funds, which are still important. And we built out strategic plans to globalize institutionally and then to launch a business in private wealth. We wanted to make sure that whatever we were creating was as excellent as it was institutionally.
The start of that was about 10 years ago. And, I imagine you've seen quite an evolution of that business. I imagine that you've seen quite an evolution of, the attitudes towards alternatives within private wealth. So what has that evolution been like? Where do you think we are in the evolution of the adoption of alternatives by private clients?
We are, in baseball terminology, probably still in spring training. I don't even think we're in early innings. If you think about the massive size of private wealth markets and how much today is allocated to private investments, it's tiny relative to any institutional segment of the market, whether it's pension funds or foundations and endowments. And I think today you're seeing proliferation of more institutional quality products. You have firms like iCapital and others helping with the technology build out. We spend a lot of time on the education piece to move the ball forward, but it's still quite early.
It's interesting you say spring training because it feels like some people talk about us being, in the second, third inning, but why do you think we're that early on?
I think we're that early on because if you look at the percentages in a private wealth portfolio today of private investments, it's typically less than 3%. Many portfolios are zero,
right?
And that would suggest that we're nowhere. But we have already been building the foundation, so I use the spring training analogy because I think about the building out of education platforms, product platforms, firms like iCapital really embarking on the technology side and trying to just solve a lot of the friction issues. So that's all happening, but it's very, very early.
Right. So even, almost 10 years later, it is still quite early. You mentioned education. What strides is Blackstone making in terms of educating financial advisors?
So 13 years ago, we launched Blackstone University, which is product agnostic, but really teaches about the different asset classes and the structures and how these fit into portfolios, case studies. And that is really augmented with both digital content online, but most importantly, it's just, in-person meetings. So we have folks on the desk everywhere around the world meeting with financial advisors and really talking about the same, anything from doing a deep dive on a particular asset class or a particular fund, or just talking about how to think of constructing a portfolio with private investments as one of the components.
Right. So it's a lot of content, but it's also a lot of engagement with financial advisors. And on that note, you mentioned that we're in spring training, to use the baseball analogy. What does it take to actually get, to maybe the 20% allocation to alternatives for private clients? Or is that a realistic goal?
It's definitely a realistic goal. If you look at the path of travel of institutional investors, even at the time that we went public, public pension funds and others had a much smaller allocation. And the reason they've lifted theirs and foundations and endowments up as well is because of what private investments offer. So if you're looking for income, they can offer greater income in the form of yield. If it's real estate, it could be tax efficient yield. And people want appreciation.
Right.
And so the combination of higher yield, higher total returns, added diversification with stocks and bonds is the reason to allocate. And I do think today there's just more accessibility, but it always takes time. It's not like flipping a switch.
But are there a couple of things that you think is going to take for us to get there? You know, is it more education? Is it more technology? Is it something else? Or is it just time in the market?
It's all of the above. It is more education. It is more technology. There are still friction points that we have to solve for. And there are companies in certain parts of the world where they're still faxing subdocs. And so getting rid of those friction points, making purchases easier, bundling funds into one, really teaching how to think about asset allocation, how these interact with other funds. I just think some of it is education and the basics of how this works. But I also think another part of it is that familiarity. If you think about ETFs, those were viewed as exotic when they first came out.
Hard to imagine now.
Which is hard to imagine now. And I believe that is the path of travel here. Ultimately, these funds will just be basic building blocks in private wealth portfolios. And the conversation around infrastructure has been ongoing probably for more than a year because it does offer diversification to the rest of the portfolio. Often you have embedded scalers in terms of revenue growth within those portfolios. It is also tax efficient depending on how it's structured. And I think you can invest in some really exciting parts of infrastructure, whether it's on the energy front or data centers. In our case, I think today the allocations are pretty small, but they're growing.
And the data center point is such a great one. You know, when you look at the industry numbers, I believe something like $30 billion is currently being invested to build out the global data centers, but that's today. By 2032, that's expected to go up to $60 billion. And of course, all the data center demand just needed to keep up with what we're doing in terms of artificial intelligence and cloud computing, et cetera. I'm curious also, private equity versus private credit, what are some of those conversations like? Are clients stepping away from private credit because maybe they're expecting lower yields, and does that mean they rotate into private equity?
So we have not seen that yet. The conversations are pretty much as follows. If you think about what investors are looking for, they're either looking for cash in their pocket or they're looking to generate appreciation value of compounding. And private credit just solves the first bucket. And so it's all weather. I don't think it's a moment in time because investors, advisors are thinking about it relative to what they can earn in other fixed income asset classes. We've been in the private credit business for a long time. So if we go back to when interest rates were approaching zero, our fund was still generating high single-digit returns and was quite attractive. So we have not seen actually any rotation out of private credit.
Right.
Private equity is generating a lot more conversation because there are more funds in the market today offering open-ended private equity funds. So that access point that we were mentioning earlier is coming true in private equity. And equities still remains a very large allocation in almost anyone's portfolio. So taking some from public equities, putting it into private, and think about it this way: if you can generate a 12% net return over 10 years, you've tripled your money.
Right.
That's very attractive.
Right. And, Joe, my last question for you, you have an amazing global purview of what's going on with alternatives adoption globally. So what are some of the differences? What are some of the dispersions? What are some of the trends that you're seeing in alts globally?
Yeah, so the basic needs are the basic needs, as we mentioned, right? It's yield and it's appreciation. But the investing habits are different. Where a particular country is on their journey is very different. The one commonality is, regardless of where you go in the world, CIOs and top of house are trying to move savings into investments. There's too much money sitting on the sidelines in cash. That's true in the US, but it's true everywhere. But then you have real divergence in terms of what investors, what advisors want. So for example, in Japan, where you've had a market for decades with zero interest rates, zero inflation, and you're now moving into an investment cycle, there's a lot of demand for private investments, but it's very, very new. But you're seeing money flow out of savings. When you contrast that to areas like Hong Kong or Singapore, where you're still able to generate savings rates of 5 to 6%, you have some stubborn cash, I would say, and rates will probably come down and you'll see the movement, but that hasn't happened yet there.
Right. Those are really interesting nuances, and at the same time, there are similarities that I like this notion of going from saving to actually investing, and given what central banks are doing around the world, that's certainly a big catalyst. Joan, it's been a fantastic conversation. Thanks so much for joining me today, and really loved hearing about the trends that you're seeing globally, about the interest in different parts of private markets that you're seeing globally as well. And of course, thank you for the tremendous work that you do at Blackstone on education and product innovation. Thanks so much.
Thank you.
Today, in our Spotlight segment, we're answering your question of the month. And I've asked Steve Zick to help us out. Steve, thanks so much for joining me in the studio today.
Appreciate you having me here today.
It's great to see you. And so this is the question of the month that we received. Structured products have seen significant growth in business volume. Is there another way to manage these structured products without so much time and effort involved? Let's take two parts of that. First of all, this growth in structured investments. What have you seen on your side? What's been driving that?
Yeah, I think it goes back to the customization of structured notes. What we've seen really grow it is the fact that there's a lot of different things you can do with it, whether it's principal protection, whether it's yield, whether it's just trying to outperform the overall market. And as you have investors and their advisors looking to customize and more closely tailor risk reward with the investor's goals, structured notes fit perfectly within that, because there's so much you can do in terms of aligning individual terms of a note with what a client's trying to achieve.
And so what are some of the complications with, managing a book of business of structured investments, and, what efficiencies can you do?
One of the things that we hear across the board is roles. So advisors basically look at this as business within a business, where they're taking either a lot of time themselves or a lot of their operations team time to go through, track whether a role is going to come, track whether they're going to reinvest everyone, whether some terms have changed, what new terms of notes are like. And it's just a lot of just operational and time and energy that goes into that. So by taking that, keeping the benefits of structured notes, but utilizing it in a separately managed account or SMA platform, you allow people to still have that type of exposure, but do so in a less operationally intensive, more investment and institutionally managed way.
A lot of advisors, have a book of business of existing structured investments. So can they really transition that to an SMA account at this point?
Yeah, kind of two parts of this. So one is, if you have products right now, you can port those into a separately managed account platform. That manager will go and look to either transition those out or keep them and basically reinvest when they are starting to roll. The other thing about this is that you have strategic exposure and you have tactical exposure. And so right now you have every person who's doing individual structured notes, even if they're trying to manage this strategically, really you have to invest on a tactical basis. And so what investing in an SMA does, it allows you to take that strategic part of the portfolio, go manage that like it is every other part of your client's portfolio, and do so just in a more efficient kind of manner. You can still keep that tactical exposure. You can still, as an advisor, go and decide, hey, I may want oil exposure, or I may want a one-off investment because these are what the markets dictate. If anything, utilizing an SMA for the strategic part of it frees up your ability to go and manage that tactical part of the portfolio as well.
That is a nice compliment to have the strategic allocation that is sort of set in stone and is working and doesn't require a whole lot of management on your part, but is handled by a manager, but also being able to take advantage of market conditions perhaps and have some of the tactical complements to that. Is there a set of market conditions that is more appropriate for using SMAs, and where are we right now with that?
There's a lot of different market environments where SMAs are appropriate, and it's going to depend partly on what your views are and kind of the SMA manager on the back of that. What we're seeing kind of this year is that with the market move upward, you're maybe having a lot of notes that you were thinking may not be called or probably won't be called, all of a sudden being in the money and expecting, okay, well, now I have to manage this role that's coming forward that may be for 5, 10, 100 different clients, right? That's going to take unexpected time away from other operations that you're going and doing. So your ability to go set this to an SMA manager allows that freedom. And if the markets keep going up and more calls are happening, you're going to see a world where people are looking for these type of solutions because the problem is just going to get bigger on that side.
Well, we do hope the markets keep going up, and that's really the long-term trajectory. But obviously, an important way to take advantage of market conditions and to take advantage of tools that are available to handle otherwise a little bit of a difficult process to manage these structured investments. Steve, thank you so much. Thanks for answering the question of the month, and thanks for helping us understand a more efficient way to manage your book of business when it comes to structured notes.
No, appreciate it.
Thank you. And we'd like to hear from you. Send us an email at yourquestion@icapitalnetwork.com and let us know what questions are at the top of mind for you and your clients. I'm Anastasia Amoroso, and thank you for joining us today on Beyond 60/40. We'll see you next time.